Okay, you made it through week 3. Let's summarize. We have various sources of financing available today when we produce content. Let's take a look at what they are and what their terms and conditions are. There are two main sources of finance that we are differentiating between. One is the recoupable finance source, and the second one is the non-recoupable finance source. Recoupable finance sources include senior loans, junior loans, which are often referred to as mezzanine loans as well, or super gap, equity investments, and deferments. Non-recoupable finance sources include production subsidies, brand integration sponsorships, crowdfunding and crowdsourcing, as well as music investments, among other. The ideal finance plan considers all of these finance sources in a balanced way. It all starts with sales agent estimates to be at a certain minimum, pre-sales to verify the market demand, production subsidies to offset the finance sources and their risks, a certain amount of a gap loan, if available a junior loan, and the equity which will be added to balance it all in the end. What is a senior loan? A senior loan is a loan that is provided by entertainment banks, bank-like lending institutions like funds, and investors. The senior loan often contains a pre-sale loan and a gap loan. It recoups exclusively in first position from distribution revenues, and it requires a bankable sales agent and bankable distributors. The senior loan also requires a completion bond insurance. All fees, costs, charges, and interest reserves are deducted from the loan amount and paid with the senior loan amount from distribution revenues. Down payments made by the distributor on pre-sales are deducted from the loan amount. Sales fees may be deducted from the down payment. A pre-sale loan is secured by pre-sale distribution agreements, and discounting may occur subject to the bankability of the distributor. A gap loan is secured against unsold distribution rights. Unsold distribution rights are established when you take your sales estimates and deduct your pre-sales. Collateral must show 200% of the loan amount, which means if your loan amount for a gap portion is $1 million, you need to show $2 million in the take column of your unsold rights. The loan amount is capped at 20% of the budget. That means no matter how many unsold rights you might have available after doing your pre-sales, the lender will never give you more than 20% of your budget as a gap loan. What is a junior loan? A junior loan is a loan provided against unsold rights. The collateral is the unsold rights that are still available after the senior loan has recouped. The junior loan recoups exclusively behind the senior loan, distribution costs and expenses, collection fees and residuals, if applicable, from distribution revenues. The junior lender requires a bankable sales agent as well as bankable distributors, and the junior lender also requires a completion bond insurance. All fees, costs, charges, and interest reserves are deducted from the loan amount and repaid with the junior loan from distribution revenues. This loan may require a premium and sometimes back-end profit participation. It allows a term of up to 5 years. In comparison, the senior loan is usually done within 2 years. There are few risks associated when taking a junior loan under consideration. If the junior loan is in default, the lender can foreclose on the movie or the television show. It is a fairly expensive loan because interest rates are very high at times. The producer and the equity investor would lose their title, meaning the copyright on the film, and their investments in case of a default. What do we refer to when we're talking about distribution financing? We do have a few options. We learned a little bit about the various distribution deals that are available to producers in an earlier module, and now we're going to connect the dots by looking at those distribution agreements and seeing how can we use them to potentially raise funding for a film or TV project. So let's start with the sales agent minimum guarantee. This is an advance from a sales agent, often offered by a sales agent who's very keen to acquire a piece of content. So therefore, they would suggest potentially to the producer an advance payment, which they then recoup from the sales that they will be making as they represent the movie on behalf of the producers to international distributors. These are distributors from all over the world who come visit the sales agent to acquire a license to distribute the film in their territory, in their country. So if the sales agent offers a minimum guarantee, that would mean that they provide cash. This is not a minimum guarantee that we would take to a bank and would have cash float. This is basically a sales agent providing cash to the producer on the day of closing so that they can use this to cover a portion of the budget. There might be cases where a sales agent would need the minimum guarantee to be banked, but that is often done then on the level of the sales agent, not necessarily on the level of the producer, unless the sales agent / distributor is a larger company where a bank would say, we can actually bank this minimum guarantee and we'll use this minimum guarantee distribution agreement to provide this advance to the producer. So it really depends who the sales agent is and who that distributor is. In this case, the sales agent would potentially become a distributor because they're making a payment. So they would potentially have the right to become a distributor and acquire certain rights, have certain rights assigned to them so that they can handle the film on behalf of the producer. They would often require a higher sales fee during the time that this MG is recouped, ideally only during the time that this MG is recouped. But many times sales agents and distributors will keep that higher sales and distribution fee ongoing even after the distribution advance has been recouped. So this is a negotiation point for a producer to have and say, I appreciate the MG, I appreciate you wanting to charge more fees, but I would like to see maybe to have the sales fee lowered at the time that the MG is repaid. So sometimes one can have this conversation with the sales agent, other times this is not something that they would agree with. And most importantly to know is that if a producer has an MG from a sales agent, this would replace the option to get a gap loan from a bank. And the reason is that both of these loans are recouping from the same collateral at the same time in the same position, which is not doable in a waterfall. So that would mean that either the bank recoups in first position from the sales that come in through distribution licenses, or the sales agent does, but it cannot be the case that both of them will recoup from the same collateral at the same time. So the producer would have to make a decision if he uses a sales agent MG or uses a gap loan from a bank. When we talk about a split rights deal, as we mentioned earlier in the distribution module, we're really talking about a deal where potentially a US distributor would buy the US forever in perpetuity with all related rights and revenues. Now, if this US distributor issues a license agreement that we can take to a bank, then this becomes a regular distribution agreement that would be financed for the producer the same way a pre-sale agreement would be financed, or any distribution agreement would be financed. So a split rights deal distribution agreement can be financed by a bank just as a pre-sale would. So when we have an all rights deal, which means not just a portion is sold to a distributor, but all worldwide rights are actually sold to the distributor. In that case, we could take this distribution agreement also to the bank if this buyer / distributor gives us a deal but not the money. So that would mean, for example, if Netflix comes to a producer and says, we're going to finance this entire production and we'll give you all the money, but we're going to pay you when you deliver the movie to us. In that situation, the producer would take this Netflix distribution agreement to a bank, and the bank would then cash flow this agreement for the producer so that the producer can then go ahead and make the production work. Now, the producer would have to remember to include all the related costs and fees in the budget, because otherwise they would be payable by the producer and not be covered by the Netflix deal, for example. So it's really important to make sure that the budget is fully covered, including all fees and all deferments and anything that relates to the production costs, so the producer actually can make this movie happen with all the costs and expenses that are related to it. Now again, all rights deals are distribution deals, just as a split rights deal. They just require all rights, not just a portion of the rights. So in this case, all worldwide rights would be sold to the distributor, and that distribution agreement can then be banked. A license deal is either a pre-sale deal or a regular sale. A pre-sale is a distribution agreement that is done before a film is produced. A sale is a distribution agreement that is done after the film is produced. They're both the same agreements. The only thing that is different is the timing. When is this deal concluded? Now, if it is a pre-sale distribution agreement, we can take that distribution agreement to the bank and we can get a loan against it, as we have talked about in the pre-sale loan portion of this module. We have the option to look at the distribution deal when it is later, for example, when it's a sales deal, and let's say film is produced and everything has been recouped, and the distribution agreement is sold after the film is done, but the buyer says, I'm going to give you 20% now, I'm going to give you 80% later. There's like a payment plan agreed of sorts. Theoretically, the producer could take this agreement to the bank, and even after the film is finished, could get a bank loan against it. It would probably be discounted significantly depending on who the distributor is. Also, because second run rights deals are not often seen to be cash flowed, because normally they're just paid when the film is delivered, but one would have the option to do so if that is something the producer chooses. Bridge loans are often done very short term, very close to the start of principal photography. The bridge loan is something a producer would only consider if they are waiting for the closing to occur and have already started with pre-production. A bridge loan does require a completion bond insurance, and it's often done during the time where the completion bond insurance is looking at all the elements, getting ready to close the film, but is not quite there yet. And the producer has already started pre-production. Maybe they even have started to shoot a few days, and all of this is needing to be bridged by someone, because most of the financing is available only after the completion bond is closed. So someone has to pay for the short period that is now happening until the completion bond is closed. And that is what bridge lenders do. They look at all the various agreements to make sure they are going to be closed. So they're very much in touch with the completion bond company to say what is open, what needs to be done, what needs to be closed, and then based on what the completion bond company tells them and how high the likelihood of the completion bond closing is, they then decide whether or not they want to issue a bridge loan. So this is a short-term loan that is provided by lending institutions or investors who do a short-term loan for a producer just before the closing, and they charge a very high interest rate. And they're really a little tricky because the producer often has not budgeted for this kind of interest rate. So this would then often have to be paid for by the producer's fees, because there isn't necessarily enough money in the budget if one hasn't planned for it. I would always suggest to put a little bit of finance fee into the budget in case a bridge loan is needed. The entire bridge loan will be paid back, including all the related fees, on the day of closing. So it's really just a loan for a few weeks, and it will just bridge the period between pre-production and some days of principal until the completion bond can be issued and all the other finance sources can be released to the film. What is an equity investment? There are two kinds of equity investments. There is development financing and production financing. Investors who provide development financing usually provide a smaller amount and are often angel investors. Development is financed by the way that development is included in the production budget, and because of that is paid on the first day of production, which is the day the completion bond insurance issues the insurance on the film or television show. When an investor finances the production cost, meaning the investment covers a portion of the production budget, that financing is recouped from the recoupment schedule and distribution rights revenues, which is not the case for development financing. Here are some standard terms. Both development financing and production financing investors require and often look for 20% on their money, which is a 20% premium. Also, for production investors, meaning the investors who provide a portion of the production budget, there is a profit participation applicable and an IP ownership. The profit participation usually is 50% of the investment amount related to the entire budget. For example, if an investor finances 30% of the budget, their IP ownership and profit participation would reflect 15%. Now, there are equity investors around that ask for different terms and different conditions. That is up to the investor and the producer to decide what works for them best. In the ideal world, I would suggest that an equity investment for a finance plan that includes a senior loan should not exceed 35% of the budget. It can be more if the equity investor takes over that senior loan position, in which case it could be 55% of the budget. There are a few investment criteria I would have the investor look at to make sure the investment is not too risky. For example, the investor should confirm that sufficient collateral is available, which means, are there enough rights available to be sold after the senior lender and the junior lender have recouped? Also, look at sales estimates. What do they say in the take column, because that is the worst case scenario? And are there enough pre-sales suggesting that this is a movie or a TV show that is verified in the marketplace? Also, what kind of non-recoupable finance sources are applied in the finance plan that help reduce the risk for the equity investor? Some equity investors do not require completion bond insurances, but most of them do. We'll talk a little bit about non-recoupable financing sources here today, but we are going to dive into this in an upcoming module. The main thing to know about non-recoupable financing is that it does not have to be paid back. So that's what that means. Non-recoupable financing means you do not have to pay this kind of money back. And there are different sources that are related to this. It's not just U.S. production subsidies, which are offered by various states in the U.S. in form of tax credit and tax rebates. It can also be international subsidies and grants that are offered by countries abroad, subject to a producer shooting the movie in that country. There are also brand integration sponsorships available that are literally monies provided to the producer for the integration of a certain brand and for the campaign, for a certain sponsorship campaign in support of the brand and the sales of the product that is being included in the film. Crowdfunding, crowdsourcing, we all know what crowdfunding is, we all know about Kickstarter campaigns and so forth. These are usually finance sources that do not have to be paid back. There are some perks associated here where maybe merchandising items are shared. Sometimes profit participations is applicable depending on what crowdsourcing and crowdfunding component is being applied. But in many cases, this is money that we do not have to pay back. Music investments, we do not have to pay back simply because it is paid back by music royalty. So it's not part of the distribution rights revenue waterfall that we deal with as producers when we put together a recoupment schedule. The music rights royalty revenues are not part of our recoupment schedule in many cases. So this looks like it's non-recoupable for us on the level of our investors and our loans. So this music investment is done by companies who look at the film as a music rights revenue source and make an adjustment and an investment based on what those music rights revenues are projected to be. In-kind services is, as we know, crew and talent and service providers who suggest to provide their services or their talents and do not require any payment for that. So that means that a budgeted line item is now not seen as an expense, therefore does not have to be paid back. This is not a deferment. Deferment would be something that means for us to defer a certain payment out of the budget into the recoupment schedule. So it's still being paid, even though it is removed from the expense line item of the budget, it is being paid later. So in-kind service really means I am taking this item out of the budget and I will not be paying it. Let's talk about how these finance sources should ideally be balanced if the idea and the goal is to reach profits with the film. We've talked about the finance sources that are available today, which include recoupable finance sources such as senior loans, junior loans, equity investments, deferments, and then there are the non-recoupable finance sources that we don't have to pay back, such as production subsidies, brand integration, sponsorships, crowdfunding, and music investments. Now, these sources are to be placed in a certain balance for us to make sense and for them to fit. It all starts with the international sales estimates, which are issued by a bankable sales agent, which is a sales agent the bank would support. And not every sales agent is bankable. So we really need to have a conversation with the bank before hiring a sales agent to make sure that the sales agent we work with is in fact bankable by the lender we are looking to provide a loan for us for. So international sales estimates are projections. These are not sales. These are not distribution agreements. These are suggested revenues. This is basically the sales agent telling us, this is how much money I think I can earn for you with this film and these elements from international distributors. That's what that is. It's an estimate. And the estimate for us to generate a finance plan based on needs to have a certain level. And it needs to be 70 to 75% at the low price level, at the low take level for the distribution minimum guarantees that we're expecting to be receiving from these various distributors. That is important. The pre-sales in connection with those sales estimates are in fact now distribution agreements. So imagine you have a bunch of distributors listed in your sales estimates. You see the distributor for England, Spain, Germany, Italy, and so forth. And they're all listed with a take number, which is a low license fee pricing, and an ask number, which is the price the sales agent will ask for. Normally, we end up somewhere in the middle, but we should ideally not be under the take level if we can help it. There will always be some sales in some regions that will maybe drop under the take level, but as long as it's not all of them, which would then mean we have to adjust the estimates lower down because they're not showing to be reflective as projected in the marketplace. So let's say we have our international sales estimated to be 70 to 75%, and now we're going out with our sales agent and are starting to do distribution sales. In this case, pre-sales, because we're doing them before we're producing the movie. In the ideal world, we want them to be at least a third of the budget. So 30 to 35% of our budget should be concluded in pre-sales. They could be maybe a pre-sale to Germany, and maybe a pre-sale to Italy, maybe a pre-sale to Spain. And these three pre-sales come down to 35% of the budget. And then we can take these distribution agreements to the bank to get them cash flowed. So this would be a portion of our financing now. This is the first amount of money that we're looking at to cover our production cost through a bank loan. The second thing we're looking at is our production subsidies. Now, usually when you go and shoot a movie in a production incentivized region, you shoot the movie first, you make all the expenses, and then you get money from the incentive region based on the money that you have spent in the region and based on what the incentive region deems eligible. This happens after the film is produced. It doesn't help us if we want to get the money before we produce the film in the region. So we are taking an estimate for the incentive of it, what it could be based on the budget that we have and based on what we're spending in the region and based on the eligibility. We can take this estimate, this basically foreshadowing of what happens in the region to a lender, and the lender would give us a loan based on what we're going to be generating in subsidies once we start shooting in the region. So this loan is then made available to us minus, of course, the lender fees, and we can use it to cover a portion of our budget. And ideally, we want to see that to be 20% net of fees as a part of our finance plan. The gap loan, which is the loan from the bank that is given to us based on unsold rights, should be somewhere between 10 and 20% ideally, or can also be covered by an incentive lender, an investor. And we'll talk about that in a minute when we talk about variations. So the gap loan is given to us based on the rights we still have to sell after we concluded our pre-sales. These are basically unsold rights, and that's the gap loan. The mezzanine loan is also referred to as a super gap, could be in addition to that, and is the junior loan, which could be anywhere from 5 to 10%. I would not suggest this to be any higher because this loan is a loan, and if it is not paid back, could result in us losing our movie as a producer if we cannot pay this loan. Equity financing should then be the balance. After we put all these finance sources together, we're hopefully looking at anywhere from 30 to 35% from an equity investor, unless the equity investor decides to take over the gap loan position, in which case this can go up to 55%. So while we're striving to have a balanced finance plan that shows us 70 to 75% of the budget estimated to be covered through international distribution rights revenues, and it shows us to ideally pre-sale 30 to 35% of our budget with international distributors, getting a 20% incentive, and then financing the balance with equity. It doesn't always work out that way. So it's not always, the case, because there could be that our film, for example, has a much stronger domestic pull. It could be something where the international buyers are not so keen, but the US buyer says, this is a great project, we want to pay more for the US. So if the US pays a strong license fee and that is verified, then the international distribution rights revenues can be dropped. But let's say we don't know yet what the US is going to do. There are certain ways to deal with the fact that maybe we're not reaching all the pre-sales and maybe we are not getting all the estimates in line. And in summary, it would mean that we have to cover whatever we're not reaching with a non-recoupable finance source. So let's say we're only doing 15% pre-sales instead of 35%. We would try to get 5% music investment and 10% brand integration, for example, to cover the 15% we're not covering right now, right? Or let's say we can increase our incentives. We're going to Europe somewhere, and instead of 20% incentive, we can reach 35% incentive. Now we have covered the 15% pre-sales that we're not generating. So all you need to remember is that whenever you have lower sales estimates, you need to, or lower pre-sales, you need to find a way to cover this portion either through an increased US sales, so something over 35% from the US, or find a way to add non-recoupable finance sources to your finance plan to offset whatever appears to be lower at the time you're putting your finance plan together and at the time you are looking at working with the sales agent and getting the financing sorted out with the various investors you're talking to. Balancing our finance plan also connects to balancing the recoupment schedule, which is also referred to as the waterfall. At this stage in our course, I would like to walk you through a very simplified recoupment waterfall. So we're not dealing with P&A, we're not dealing with residuals, we're not dealing with all the other stuff we will learn about later. So when we look at a simplified waterfall, we see that we have distribution revenues are coming in, we're paying back our bank loan first, the senior loan, we're paying back the junior loan next, then we're paying deferments if we have any, and then we're paying the equity investment. This payment is done in a ranking order. By the way, the sales agency fees and the distribution fees can land before the senior loan or after the senior loan. So that's really a conversation to be had with the bank to see where they allow them to drop, and with the sales agent to see if that is acceptable to them. Sales agents know that certain banks do have a requirement for the sales fees to be deferred. And sometimes they split them up. Some can be paid before the senior loan, others can be paid after the senior loan. So it's really a negotiation situation. Now, while we are recouping senior loan, junior loan, deferments, and equity in a ranking order, one after the other, profit participations are actually paid at the same time. We refer to this as pro rata pari passu. So all the profit participants get paid their profit share at the same time from the revenues that are left over after we paid back our loans, our investments, our deferments, and any distribution costs and any finance costs we have associated to these items. I want to walk you here quickly to the case study where we're comparing the same film with the same script, with the same budget, with the same shooting location in a way where we show two different finance plans to cover the budget. In this example, we're basically applying our international distribution rights revenues at 75% of the budget, as we have learned earlier, is a strong, healthy base, and we are looking to sell the film in the US for 35% of the budget. So altogether, with a $5 million movie, we are looking at the worst case scenario being a recoupment of $5,500,000. And all of this is now in this situation paid by an equity investor who issues a check for $5 million, paying for our entire production cost. As you see, we have to pay a few people. We have to pay the collection agent who collects all the revenues for us. We have to pay, of course, the sales agent. We have no bank loan, and we have to pay our equity investment of $5 million back. So when we look at all these costs that are generated here, which are industry standard fees, we notice that we're running a loss of $435,000 because we don't have enough revenues and our equity is very high. So we are in this first 100% equity situation running a loss based on the finance plan items that we would usually apply if we would have structured our finance plan in a different way. So if we would choose to do this movie with 100% equity, in fact, we would be losing money. Let's take a look at the same movie where we are then applying all the things we've learned about. We are estimating again that the film can make 75% from the international distribution rights revenues as well as 35% from the US. So all this is the same, 5.5 million is expected to be generated. But we're then going ahead and we are applying some of the things we learned about. We're doing pre-sales of 35%. We're using a bank loan for these pre-sales. We're using a gap loan for the unsold rights. And we are basically using a production incentive because we're shooting in a region where we can get some non-recoupable financing, and our equity drops to 25%. So let's take a look what that looks like. So if we put together our finance plan in the way we learned about, which is 35% pre-sales, 20% incentives, and the rest is the equity, we're actually making money with the very same movie. We can even pay the equity investor a profit participation. So this is to show you that structuring the movie's costs in a finance plan situation or with a finance plan that is balanced is extremely important in order to generate any profits whatsoever. This concludes our Module 3 regarding finance sources, and if you have any questions about the material, please feel free to email me.